Okie dokie. Okie dokie, everyone. Can I start off with by either saying either a very good evening or good afternoon or even a good evening, depending on where you are around the world. And welcome and thank you for joining me tonight on tonight's latest episode of the How I webinar series, presented by myself and obviously for Stratton Markets. Now, tonight's episode is a conjunction of two parts. Tonight's episode is called How I Got to Understand Candlestick Patterns for Price Action Trading. Because part of price action, or using price action when it comes to trading, is identifying certain candlestick patterns. Now, this is a combination of part one for candlestick patterns and part two for price action. So it's, of course, written by yourself, which is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. Now, before we get on to an introduction on myself and tonight's agenda, of course, we're talking about online trading and CFD trading. And like with every type of investment, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. With that out of the way, let me introduce myself. Like I say, my name is James Trescothick. I'm the Chief Trading Educator here at Stratton Markets. Yeah, that's me in the corner, the plump, hairy, wrinkly old fellow. I've actually been in the financial service industry now for about 20 years. I actually started off in mortgages at 18. I am now 40, believe it or not. I started off in mortgages, specializing in commercial and buy-to-let mortgages before moving into pensions and then alternative investments. I then moved into trading around about 13 years ago, and I have indeed traded myself quite a lot. I actually traded for a prop company in Dubai, where I traded gold options for the Dubai Gold and Commodity Exchange, then moving and running a floor at the Philippine Stock Exchange before moving into portfolio management, and then later down the line, obviously, education. I'm a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, The Street, and several newspapers and magazines. I'm an avid market commentator. I'm very passionate about this industry, very passionate about the markets. And I'm often asked about my opinion on what I see things going. Not that, of course, I always know all the answers, because if I did, obviously, I will be a very rich man. And I'm a well-known public speaker, and I've spoken at industry events around the world, including the likes of South Africa, Dubai, etc. Now, tonight's agenda, like I say, is part one of candlestick patterns and part two of price action trading. So tonight, we're going to really sort of focus more on candlestick patterns, and we're going to talk a little bit about different chart styles, the different options you have there. Then we will discuss what are candlestick patterns, how to read them. Then we'll do an introduction into some of the different patterns, followed by, at the end, future educational events for the rest of the month of December, and then my usual question and answer session. Now, after we've got the agenda, let me put myself on camera. There we are. There I am. Hello. Hello, everyone. As you can see, it's actually raining here, so I got caught in the rain. So forgive me. I've not actually slicked my hair back. It's just my hair was wet, so I got caught in the rain before this webinar, but never mind. Right. Moving on. Different chart styles. As you can see, there is several different chart styles available for your analysis. Some people prefer certain types over others. Again, like I always say, trading is a very personal thing. So it does actually fit your own dynamic and how you see things. But there is certain advantages over certain types. But let's go through some of the different charting different charting types. Now, of course, you have the dots. Now, the dots tends to show you have the green and the red, where an asset closed during that unit of time. And obviously, the red shows you it closed lower, green shows you it closes higher. Okay, useful to see what session, etc. And some people can maybe see, something in it, but it doesn't give you an awful lot of information. The other is known as area. Now, area, again, really can show you the overall direction of an asset, but it also shows you sort of the volatility and the volumes and how many people are buying in and selling in. And as you can see, the area decreases when there's more of a sell rate. Again, useful if you can, if you find a use, but again, doesn't give you an awful lot of information. Then you have line. Line, again, sort of shows you, and very similar area, sort of shows you the overall direction of an asset. Nice to see the direction of an asset, but again, it's limited into showing you really what is, more information which you could possibly use. Then you have bar. Now, bar gets a lot more useful because, again, it shows you a lot more information which is available to you. And you can actually sort of read it and things like that, etc. But again, it still is quite limited. It's better than it's better than obviously line and area and things like that, but it tends to give you a little bit more limited coverage on what you can actually see and what you can actually read into. Sorry, just had a quick mute my phone. Always the way, isn't it? Just as you're talking, you get a phone call and you have to mute it. Oh, well, do forgive me. 1 second. My apologies. So sorry. So again, it shows you sort of limited amount of information. But then, of course, you have candlestick. And this is what we're talking about today, is candlestick charts and candlestick patterns. Because candlesticks gives you a lot more information for you to read and then ascertain and then possibly look for patterns where an asset is potentially going. So this is a candlestick. This is what candlesticks look like. And I'll go through what it actually is and what it means and what you can actually read into it. Now, a candlestick displays a movement in price of an asset in graphical form. Depending on your selected time period, each candle represents a chosen unit of time. So, for example, if you set your chart to a 30-minute, each candle, i.e. these, let me get my pen, i.e. these, will represent 30 minutes. If you selected 1 hour, then each one of these will represent 1 hour of time. Now, in this illustration, and it tends to be the standard, okay, in this illustration, the green candle is showing the asset closed higher in that unit of time. So say, for example, I've chosen 30 minutes. The green candle will show that that asset closed higher at the end of that 30 minutes. The red candle displays that the asset has closed lower in that unit of time. So say we use 30 minutes, that means in 30 minutes, that asset has closed lower. But that's not all. This candle, or the candlesticks, give us a lot more information. So if it's a green or bullish candle, this shows us this level, the bottom of the body of the candle. These are called bodies, by the way. These are called wicks. These lines here underneath is called wicks. Okay, so bodies and wicks. Get it? Candlestick, wick. Yeah, very imaginative. They're incredibly creative. So if it's a green candle, the bottom of the body shows us where the asset opened in that unit of time. And the top of the body shows us where the asset closed at that unit of time. If it's a bearish candle, i.e. in this illustration, a red candle, the top of the body shows us where the asset opened at that unit of time. And the bottom of the candle, or the bottom of the body, sorry, shows us where the unit closed at that unit of time. Now the wicks. The wicks, the wick above, the level above, the line above, will show us the highest that asset went to in that chosen unit of time. The same on both a bearish and a bullish candle. And the bottom line, or the bottom wick, will show us the lowest point that asset went to in that unit in time. Not where it closed, but where it went to, the high and the low that asset went to during that unit of time. So this is the gift straight away. You see, this is why so many people, certainly in currency trading, commodity trading, people with their candlestick charts, is because it gives us so much more information in very simple illustration. Very simple. And again, straight away, it gives us an awful lot of information for us to see. Now, because this gives us so much information, illustrates us so much information, we can then look at different patterns and try and identify patterns. And hopefully, by identifying these patterns, we can potentially see where the asset may be heading next. So we have our charts, and we see our charts like this. Very pretty, very illustrative. But if we look closer, and then even closer, we could possibly identify patterns which could potentially give us an indication where that asset may go. Because traders look for certain patterns to try and determine the buying and selling behavior of the market. The theory is that certain patterns can possibly indicate future movements of that asset. This is what it's all about. We read these patterns to try and see, or try and determine where an asset may go. So I need my coffee. It's very rainy outside. I don't know if you can hear it. Need the coffee to warm me up. So yeah, the theory is that certain patterns could possibly indicate future movements of an asset. And we're going to go over a couple of these patterns just so we can sort of identify it, show it and display it to you. And then, like I say, have a look at it. Now, this is one pattern which you can see or potentially see, which could, again, potentially give you the heads up where an asset may go. And this is called the hammer and inverted hammer. The hammer is known as a bullish reversal pattern. And traders look for it, as some believe it indicates an end of a downtrend. And this is what a hammer looks like. You see? It's got a smallish body with a long wick. That's what a hammer looks like. It's the hammer pattern. But you've also got the inverted hammer. The inverted hammer also potentially indicates an end of a downtrend. An inverted hammer looks like this. You've got the body, but this time you have the wick above it. Now remember, this pattern, both the hammer and inverted hammer, has to form at a bottom of a downtrend. It can't form when the market is ranging, when the market is on an uptrend, because that's a different pattern. This is at a bottom of a downtrend. And let me show you what I mean by this. Now, this is the euro dollar on the 30-minute. Okay? So, we have the market here on the downtrend. And here we go. We have a nice inverted hammer pattern there. The market then moves and changes, reverses into a upward trend. We have another example here. Market on a sell-off, a downtrend. Then we have a hammer, a normal hammer this time. And again, the market moves on an uptrend. Again, you can actually see it here, down, down, down. Again, a hammer there, and the market moves higher again. So remember, the hammer and the inverted hammer has to come at the bottom when the market is selling off. And traders look at it as an indication that that sell-off trend may revert into more of an uptrend. And again, we can see it here. Again, a inverted hammer, sell-off, 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 inverted hammer, and then, of course, the market reversed and then started moving higher. Let's look at another pattern. This one's called the bullish engulfing pattern. Now, the bullish engulfing candlestick pattern, again, potentially indicates a reversal in a downtrend. A lot of these patterns that traders look into, which I will say, a lot of patterns the traders look into, is to try and identify when a trend is over. Okay, or when a trend is finishing, because that's when they decide or try and look to jump in to try and capture the reverse. Okay, so a lot of this is to do with the trend or identifying when a trend may be finishing. Now, a bullish engulfing candlestick pattern, again, identifies a potential downtrend. And what you'll tend to see to identify this pattern is if a bullish candle at the end of a downtrend, not again when the market is ranging, not again when the market is on an uptrend, but when the market is on a downtrend, the bearish candle, i.e. this candle for the example of this illustration, is engulfed completely by a bullish candle, as in it takes over the body and majority of the wick of that bearish candle, then it indicates that the market direction may be changing. Here's an example of that again. This is the pound US dollar on a daily. Again, looking for the pattern. I can see it here. Downtrend, down. It's again daily chart. Downtrend, 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 downtrend. Bang. We then have a bearish engulf because it engulfs that last candle considerably. And what do we see? The market was on a downtrend. Bullish engulfing candle. And indeed, the market then reverted and started moving higher. Let's do another one. We're doing a lot on the uptrends. Let's look at the Morningstar. Again, is another uptrend. Another reversal pattern people look for. Because patterns are not just about one candlestick. Patterns can be more about a combination, like you got the white soldiers, for example. That's another pattern, which I'll discuss probably in part 2. The Morningstar, okay, this is part of a 3 candlestick pattern. And this time, it consists of one bearish candle, a smaller bullish candle, and a bigger bullish candle. It looks a little bit like this. You have your bearish candle, followed by your smaller bullish candle, which still opens round about the close, but it's, it's still a little bit higher, followed by your second bullish candle. Again, traders try and look for this pattern to try and recognize a potential bullish reversal. Let's have a look at an example. Again, this is the pound US dollar on a 30-minute chart. Again, this is for a reversal. So downtrend, 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 downtrend. Bang, you have your bearish candle, followed by your Morningstar, followed by your second bullish candle, which is larger than the Morningstar. And hey presto, market on downtrend. Market then reverses on a uptrend. Let's look at another pattern. This is called a shooting star. Of course, we've been talking a lot about identifying when a downtrend is going to reverse into an uptrend. Let's do the other way around. Let's do it when patterns we can look for when the market is on an uptrend, and then looking for the potential reversal of that. This pattern looks a little bit like a hammer, an inverted hammer, but instead of forming at the bottom of a downtrend, or downtrend, you see me, downtrend, it actually forms at the top of an uptrend. And it looks like this. Again, looks very similar to the hammer, or actually very similar to the inverted hammer. But like I say, it has to appear at the top of the uptrend. It's the opposite of the hammer. Again, like I say, this is used by traders trying to spot a reversal in direction. Let's give you an example here. This is the euro sterling on a daily. Again, we can see it here. Uptrend, 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 uptrend. Ba-da-da-dum. We have the shooting star forming here. And hey presto, what happens? The market starts to sell off again. So uptrend, 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 falling star forms, and then the market sells off. One more to look at for a potential reversal of an uptrend, and it's the opposite of the engulfing bullish candle. This one's called the engulfing bearish candle. Like the bullish engulfing candlestick pattern, the bearish engulfing candlestick pattern is the opposite because it occurs or appears at the end of an uptrend. So it looks like this. Again, as you can see, it totally pretty much engulfs the body of the bullish candle beforehand. Then it indicates, again, this has got to appear, not when the market is ranging, not when the market's on a downtrend. It's got to appear when the market is on an uptrend. And that gives you the indication or the idea that the market is indeed reversing. Because, okay, this is what the traders are looking for, a change in direction. And this is a really good one, actually. This shows us a lot. Actually, this is the dollar CAD 1 hour. Okay. Uptrend, uptrend, uptrend. Bearish engulfing candle engulfs the last bullish candle, and the market starts to sell off. And as we can see again, the market starts moving higher. Bang! Bullish engulfing candle engulfs bearish engulfing candle engulfs the previous bullish candle, and indeed the market then starts to sell off. Again, uptrend, uptrend, uptrend. Again, bearish engulfing candle engulfs the previous bullish candle, and the market starts to sell off. And there's another one here. Market starts to buy in, but then you have the bearish engulfing candle, and the market this time really sells off quite strongly. One more, and then obviously we'll discuss more in part 2. The other one is known as the abandoned baby. It sounds really brutal, but it's a lovely little pattern to look for if you can see it, and it's obviously nothing to do with babies. It's just a nickname. It's like this industry, it loves its jargon, loves its nicknames, loves its thing to have on this, and this is no different. This is called the abandoned baby. Now, you have the bearish and the bullish abandoned baby. Again, of course, obviously, the bullish can be used to indicate a change in direction upwards, and the bearish abandoned baby pattern can give you the heads up of a bearish reversal. But let's just talk about the bullish reversal for the time being, okay? So this is what it looks like on a bullish abandoned baby pattern. You have your bear candle, and your abandoned baby looks like a little bit like this. Now, first of all, it has to open with a pretty big, reasonable sized gap from the previous bear candle. The other thing it has to have a very, very thin body, i.e. the open and close has to be very close together. So it's instead of having like a large body like you have on this candle here, you have a small body, more like this here. Again, the wick, the high and the low, has to be pretty thin. Okay, pretty close together. Okay, showing that the market is rethinking things, hasn't quite decided what to do, is uncertain. But this indicates that potentially the market sell-off has stopped. The bulls are considering their options and are likely to jump in again. But it's not just this you look for, because then what you look for next is if you then see a bullish candle, the next unit of time open above it like this, indicates that indeed potentially the market is changing direction. But like I say, I have to illustrate the key candle, which is the abandoned baby, thin body, and has to be a gap from the previous bear candle. There can also be a gap from the bullish candle, but there has to be a gap from the bearish candle, and it has to have a very thin body and very slow or low wicks. Now, think about this pattern. This is why we're only talking about the bullish abandoned baby pattern, is that it can be extremely rare. Okay, and like I said, when I do all my webinars, I do the charts on the day to try and show things recently, not what happened months ago. I look for the day, and like I said, I could only find one example of a abandoned baby or bullish abandoned baby, and here's the example I found. This is Amazon on 1 hour. Okay, so it's stock. And as you can see, the market selling off Amazon shares here. But then you have your abandoned baby dropping with a gap, very thin body, very thin wicks. Then you have your bullish candle. Again, doesn't matter, there's a gap when it opens, open with a gap, indicating a reversal in that direction. So abandoned baby is extremely rare, but can give you a good indication that market direction is changing. Upcoming educational events for the rest of December. Now, on 11th December, I'm doing part 2 of my candlestick pattern webinar. This is part 1 and part 2. This is sort of part 1 of candlestick pattern and part 2 of price action, because part of trading price action is using candlestick patterns. But on the 11th, I'm doing proper part 2 of candlestick patterns. In this one, I'll talk a lot more patterns, illustrate a lot more patterns, plus show you how certain trading techniques on these patterns. So that's on the 11th of December. I'll also talk about the head and shoulder pattern as well. So that'd be quite a useful one to do. Then on the 27th of December, the final one for the year is how I came to understand the Santa rally and fundamentals. Actually, it's not the 17th. That's actually the 18th. That's a typo. It's the 18th of December was how I come to understand the Santa rally and other fundamentals. And of course, then I released the January schedule for 2019 and all the exciting other possibilities and other things to talk about happening next year in the market. If you wish to reach out to me, ask me any questions, give me any feedback, any opinions, or maybe you would like me to talk about any sort of future topics or future things you'd like me to cover, please feel free to email me at james@strattonmarkets.com, or indeed follow me at my Twitter account, which is @jtruskothic. Again, let me get myself off camera here so you can read the text properly. Like I say, tonight we've been talking about CFD and online trading. And like with every single investment, it does indeed carry a great deal of risk. I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. Now, I will usually do my question and answer session, etc. Let me just move on to my next bit here. Here we go. Question and answer session. Is there any questions you have for me in relation to the webinar I've covered tonight? Any questions at all? Okay. Did you at least enjoy it? Okay. Thank you. I have Richard there. He said, yes, enjoyed it muchly. Looking forward to part 2. Oh, very good. Thank you, Richard. What do you trade, Richard? Yes, I have interest. Are you a currency, commodity, or stock, or indice man? Oh, he's a currency man. Okay. You like the liquidity or currencies. Good for you. Keith, thank you, Keith. He enjoyed it immensely. He's looking forward to part 2 as well. He wants me to do oscillators. Okay, I've done one on oscillators, but I'm happy to do another one on oscillators as well. Here's the thing about when when I do these webinars, I try and keep them short and sweet, and I do it in part 1 and part 2, because otherwise the idea of you find people listening to me for over an hour might be a bit overwhelming. So if I do it in part 1, part 2, you can get in bite-sized pieces, and hopefully it's easier for you to take in the information and then obviously build upon it. Is there any other questions at all? Okay, perfect. In that case, if there are no other questions, what I would like to say is, depending on where you are around the world, can I either wish you a very good morning, or a very good afternoon, or a very good evening, depending where you are around the world. Thank you so much for joining me tonight. I hope you found it insightful and useful, and maybe enjoyed it slightly and didn't get too sick of my voice. Till next time, can I wish every single one of you a fantastic day, and every single one of you at the same time, trade safe.